now we have the big two from TCS, Rajesh Gopinathan and Samir Seksaria. Let me take it from my macro angle. I cover economics, and what the IMF tells us, 21 growth was 6% for global economy, 22 was 3.7, and 23 is going to be 2.1. I mean, it's huge. I mean, just what red flags in your world?
See, our business is on a very focused customer set, both from a market perspective as well as from a client universe perspective. So the way I would look at it is, rather than try to parse the overall big global economy picture, if you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today compared to 5 years ago or 10 years ago. So balance sheet repair has happened. The EC money actually resulted in a fairly good disciplined execution on that side. The financial markets, of course, react to the repricing of the asset on terms of where the interest rate is. But when we are looking at actual individual companies, they are more impacted by the supply chain issues, which have kind of played out through the year. They are in fact on the absolutely on the getting mended. Geopolitical issues in Europe will continue to have an impact, especially for that market and for some of the long supply chain kind of industries. But others in UK, in US, they're in a much more stable situation. So our own view is that there will be some impact of the overall negative commentary that is there in decision making. But when we take, let's say, a 6-month view or a 12-month view, we are much more positive, because we believe that our client universe, their underlying business is in good shape. And that is what is driving our positive outlook on our business compared to where the overall economic commentary is.
Okay. Samir, I wanted to ask you about the margins. It's impressive that at a time like this, you are, not only delivered better margins than quarter ago, you're promising to exit at 25%. How are you so sure, and what led to that improvement?
Okay, fair. So I think this is still an aspiration, but we have put it out at the beginning of the year when we gave our full quarter increments, and we came in at 23.4. We said we want to exit this year at 25, and structurally we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. Two specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
And there is still space over there?
There will be operational levers from an execution rigor perspective, which always will be there. Fees to external consultants still provides us an opportunity. There will always be puts and takes in terms of how it would set up. Second factor is currency has been beneficial to us, and at that also we have been calling it out.
That may not be there this year, we are told.
Let's hope.
Rajesh, just talking about Q3, what explains why you didn't see higher furloughs when your peers did and called out specifically?
I think it's a question of, it's been quite a few years also, Rima. So to exactly, and to say that it is higher or lower, the variations are not that material to be a commentary item. So what we have said is that it is regular, it is coming from the same, so we have more than the volume. We have put our commentary based on where is it coming from, which markets is it coming from, which industries is it coming from. Are we seeing something completely surprising, some industry that never used to do furlough, standing up and talking about furlough? So none of that has happened. The actual volumes, it's not that material to be, the variation is not material enough to be called out.
Samir, you've announced a special dividend, as in the board has announced a special dividend of 67 rupees. Does this rule out a potential buyback? Because the window for the next board, a buyback announcement, is in the next couple of months. So should we expect no buyback from TCS?
So, see, our capital allocation policy has been consistent.
Yes.
And if you look at technically, as the regulations currently stand, we couldn't have done a buyback in this year. We completed our last buyback because it has to, at the end of March. So if we had to do something in this year, the buyback option wasn't available. On an ongoing basis, we look at a combination of various measures of distributing cash flow, and it could be both dividends as well as
So a buyback could be on the cards in Q1 FY24 when you are eligible?
That's always an option available.
Okay, that's the nearest you will come, is it? Okay, Rajesh, I'll tell you, from what the investors took home, the two big fears are that your TCV, your total contract value, was only 3% higher. Last year, it was 10% higher. Your total workforce is actually a few thousand lower. Both these look like 23 is going to be difficult.
Lata, actually, I should have had that number, but our TCV is now, earlier it used to be in the 6.5 billion range. Now it is consistently staying in the 7 to 9 billion range. So on an average, if you compare it, because TCV by nature is volatile. Right. So on an average, we are not, we are in quite a good shape. And we have always said that the multi-billion-dollar deals are one-offs, and that needs to be, you cannot predict as to when it will come. So overall TCV trend lines, and so there are three layers to it, right? Overall pipeline, qualified pipeline, and then the TCV. Everything is in a fairly good shape. The place where there is weakness, we call that out in Europe, where qualified pipeline continues to grow, but the actual decision making and closure on the contract side is getting delayed. And there we see a definite decline, which is where our commentary on Europe is a bit much weaker than what it is about the rest of it. Whereas if you take US or UK, deal closures are continuing at a fairly good clip. In fact, UK had specifically called out, though the overall operating environment is challenged, actual decision making is very positive, and people are moving forward with transformative projects.
Okay.
Rajesh, you are confident about a double-digit growth this year, FY23. Are you as confident? How are you thinking about double-digit growth for FY24?
This is a milestone quarter for me. This is my 40th quarterly.
Congratulations.
So batting back this question again and again. So keep that in here, that we don't want to get drawn into making a specific comment. But otherwise, as I said, these 2 years have been a fairly strong growth years. The next year is like more a balanced year, a consolidation year, both on the revenue side as well as on the overall profitability side. The perspectives are very different depending on the markets. And I think the most important one is that we have a divergence in US between what the larger commentary is and what our own perspective is. In Europe, we are fully aligned to where the macro commentary. And UK, we are executing totally differently. In UK, we are now by far the largest technology services provider. So significant market share gains, significant growth, very clearly highly differentiated positioning. All of that is playing out. So overall, it's a good, I just used this analogy earlier, that it's a good test pitch.
Okay.
There's
so
something in it for everyone.
15% which comes from Europe, you see, is under threat.
Absolutely, where there is clear, and another 15-20% which is from all the other markets, about 15%, they are very volatile to call. So they are difficult to call in any given year. And the 15% Europe, which has been a big growth driver for us till last year, that is off the boil and likely to remain soft in the near future.
Rajesh, on the conference call yesterday, you said that you have won 20 optimization-focused large deals in the first 9 months of this year, versus 16 in the similar period of the previous year. So 20 cost optimization deals versus 16. What would that same number be for growth and transformation, where we are seeing some slowness?
I don't off the have it, which is one of the reasons why I hesitate to give these numbers, but I don't have the cut on the other side.
But is it significantly lower?
So on a quarter-on-quarter basis, our deals have been equal. That is between Q2 to Q3.
Okay. On GNT?
No, overall. So to that extent, yes, GNT will be. But on that, this thing, on a larger one, larger period, I don't know the number.
And if one big geography, that's Europe, which is about 15% of your revenues, is challenged, is it not fair to assume that FY24 growth could be lower than FY23? Not getting into numbers, but...
See, that's the realm for the people who are going to make a bet on the stock. But for us, it's more about playing the market as it is. So, as I said, our stance in North America is very forward.
Sure.
In our stance in UK is very forward. Our stance in Europe is a bit more on the back foot, and we are playing it for individual ones and twos and scoring where we can.
Has pricing played out, Samir, the way you anticipated, the increase in pricing?
Like I called out, we are getting pricing improvements on a case-by-case basis, but given the inflation which the world has gone through, overall the expectation would have been that as a CFO at least, we would have seen much higher uptick. That is yet to come, and pricing reflects also over the quarters. It doesn't reflect in one quarter, but realization definitely has seen an uptick sequentially as well as year on year.
So it's played out as per your expectations.
Realization uptick has been there. Revenue productivity has been there.
Would it be more fair for you to say that the TCV range should be 7 to 8 rather than 7 to 9? Do you have that much skepticism over 24?
No.
Okay. So you could get TCVs above 8?
Absolutely, absolutely. And this 7.8 also, we have been on average above 8 only.
Yes.
So I don't think that need to reduce the TCV range or to narrow it down. There is enough. Again, as I said, the qualified pipeline, which is the one step before that, is still continuing to grow. Right? In absolute terms, it is continuing to grow. So there is no reason to assume. It is the decision making that is getting delayed. We are not hearing of project cancellations. We are not seeing people stepping back and saying that, guys, put a hold on everything. It's more of the delay in committing and starting of new programs.
So
we are being warned about time, so you ask your best question now.
No, $7 to $9 billion of a quarterly deal win run rate stays for FY24 as well, right?
I think it's a fair one, absolutely.
Okay. Does 26% now become a little more away from your reach margins?
First target get to 25% and then get to nearer
promised.
to...
25 you're saying is in the current quarter.
We are looking forward to 25% exit in this year, and then we'll try to get to 26 as soon as possible.
Welcome back, and the TCS top brass is here. We have with us NGS COO and Milind Lukkad, the CHRO, actually the more important person in a company like TCS. Gentlemen, congratulations actually for beating street expectations. I have a lot of negative scenario questions, but first the positive one, NGS. 2.2% growth and an improvement in margins is not a small achievement given the circumstances. So what led to that, both these positives?
I think it's a very, very satisfying quarter, 13.6% year-on-year growth. I think we stayed very focused with customers, being part of them, working with them, put feet on the ground to see what matters to them in these tough times, right? Especially as they grapple with uncertainties in the macro side. What does it mean for them to stay ahead of the curve? Where is it that new technologies can help them bring efficiency, help them bring automation, and then at the same time work with them to define the future now, right? And I think that's what really is. In a nutshell, I think it's about cloud, right? Everybody moves everything to cloud. And
as you call the race to cloud.
Yeah, race to cloud. And then it's about, you don't stop by moving to the cloud. You keep improving it. You keep bringing in automation. The beauty of these digital technologies is that a new technology comes in, a new way of working comes in every month, right? So short is the improvement possibilities, with the result that customers are always willing to adopt something new for bettering the growth, bettering the efficiency, and bringing innovation to differentiate themselves in the marketplace.
Okay, well, I have more on that, but before that, Milind, while it is a large number you hired in terms of freshers, the street is a little worried that your total headcount is actually a few thousands less. Okay. is that preparing for likely fewer orders in this year?
So a couple of points I would make. One is basically if you look at year on year, we have grown by 57,000 people.
Yes.
So that's almost 10% growth on the number which we had last year. And we also hired a lot of people last year, and basically close to 200,000. Yeah. And then a lot of talent development over the last 3 quarters, and eventually they are getting deployed now, in this quarter, and thereby increasing the utilization a bit, and also efficiency in the organization is basically causing this headcount to come down. But actually, if you look at it, look at 2 years together, I think will be even.
Yeah, but it's only the third time in the entire record of TCS quarterly that it is lower. So is there just a preparation?
It is.
Let's look at the orders and then hire.
Let me assure you, it is nothing to do with demand. Okay. It is everything to do with efficiency, and it is everything to do with investment which we made.
Fair.
And she just wanted to talk about your deal wins. In FY22, the total contract value or the deal wins went up by 10%. And that's helping you clock in a double-digit growth this year in FY23. 9 months FY23 TCV is up only 3%. Does this not signal that growth next year will slow down?
I don't see it that way, but I think it's a function of the order book that we have, for sure, that we have to keep executing it. As we see it, there is a very strong pipeline. As I said, the qualified pipeline looks very good. In certain markets, the decision making has been a little slow, but we don't attach too much to the macro situation and the client situation, because we work very closely with customers. If you look at UK, for example, when so much of uncertainty around, we have grown year on year that market by 15.4%. So I think across verticals, whether it's a broad-based order book that we have got, broad-based pipeline that we have got. So the kind of execution rigor that we have brought in, the kind of growth that we are seeing in the cloud and artificial intelligence and machine learning kind of work. So I think it all looks positive and gives some weight for the macroeconomic uncertainties, especially in Europe, where the decision making will become clearer in the next 6 to 8 weeks' time.
But there is a correlation between the deal win growth rate and future growth, right?
Yeah. No, it is there, but some of them are multi-year deals. So you have to look at it from a perspective of, for example, whatever the deals that we clocked last year, it's typically it's not for just 1 year. It's for a multi-year life cycle, multi-year deal. So in the short term, if you really look at it, for the order book that we have for the coming year, 23 and 24, looks positive. I think we've got an order book which we have to execute well. As long as we execute well, which we are really good at, I don't see a particular challenge in it.
Okay. Just one more question about Europe. You repeatedly said in the press conference, Europe is challenging. And that's 15% of your revenues. Is it just slowness in decision making, or are you seeing deal cancellation or no new order wins? What's happening in Europe?
See, there are 2 ways to look at it, right? In these kind of certain uncertainties and amount of caution that the customers express. First thing is the cost and optimization, vendor consolidation, those kind of opportunities are really picking up in Europe, right? Those are the ones which are getting accelerated. So there is a consolidation opportunity, there is a market share gain opportunity for TCS. In that
Even
aspect.
in Europe?
Even in Europe. But on the growth and transformation side, people are wanting to get this winter over, right? And see that, look, in that sense that the next 2 months are going to be the key thing. But at the same time, they all recognize that the journey to cloud and journey to a cloud native, microservices driven, ecosystems driven architecture in which they want to redefine their future is irreversible. They've gone that path. The pace might take a little slow, but if they delay it for too much, then the technology change will be too huge.
So you're saying that transformational deals are taking time. Those would be the high margin ones, right? Well, Milind, I wanted to ask you, how are the wage hikes in your off-site categories? I mean, I'm trying to gauge how severe is the wage pressure abroad.
I think what we have given last year, I think we don't expect that to change in the coming years.
Okay, okay. Because
So it is. So I think
the macro numbers are indicating wage pressures are stiff.
yeah, it is there, but we have been able to. That's why we have been able to manage and our operations efficiently and effectively, and just ensure that we actually do similar to what we do normally every year. And I don't see that changing right now.
So there is a pressure there in
So
terms
I
of
think,
wages.
but you know, we have to respond to those pressures very, very well, right? By operating it better, by being able to price it better, all our deals and all of those things come together, and thereby we are able to do that. And I don't see actually again see that changing in the coming years.
Milind,
NGS,
sorry.
yeah, 1 minute.
Yeah, sure.
NGS, you were, I just wanted to know whether there were sectors that gave you more orders. I'm looking at it from a macro standpoint. While there were pressures in, you know, for instance, retail and finance, Goldman Sachs has sacked people. We've heard positive things in commodities, metals. Do you all also service those sectors, and did you find more orders there?
It's a fairly broad-based growth that we have seen. For example, retail, CPG, and travel and hospitality grew upwards of 17-18% for us year on year. Banking, financial services grew by 11%. Manufacturing grew by about 12%, and rest of the verticals grew between 9 and 10% year on year. Even in the order book that we have, the pipelines that we have, both in terms of mid-sized deals as well as large-sized deals, is very, very broad-based across markets, across verticals. So even the large deal pipeline looks good. We are working on some key large deal opportunities which we hope to convert, going into the next financial year, right? So overall, I do not see any slowdown in terms of the deals that are coming into the pipeline, right? But the decision making in certain markets are a tad low or delayed, given the uncertainties that they want to take into account.
TCV to revenue may slow down. That is, book to bill may slow down.
No, TCV to revenue will be intact, but making it into pipeline to TCV might get delayed.
Qualified pipeline to TCV.
TCV might get delayed a bit, specifically in growth and transformation opportunities.
Okay. Milind, FY22 was a supernormal year for employees of TCS, right? Not just in terms of wage hikes, but you gave a lot of bonuses, etc. Do you think next year we will see an overall lower wage bill for TCS? Because attrition is easy? Overall, including bonus.
I think like I said earlier, I don't expect that to change, but we'll obviously play it by the year and see how the situation evolves, and based on that make the decisions.
How much may attrition ease, you think?
Pardon?
How much may attrition ease?
No, I think, this quarter itself, although LTM wise we are 20 basis points lower, but if you look at quarterly annualized attrition, we are close to 6% down. And I expect that trajectory to continue.
Thank you very much, NGS.
Thank you.